Finance may seem complex, but at its core is a simple truth: the time value of money. A rupee today is worth more than a rupee tomorrow. Why? 3 reasons. You can invest it and earn more. Inflation erodes its value, and the future is uncertain. This principle is the foundation of all financial decisions, from personal savings to valuing companies. Every financial choice is a trade-off between money now and money later. We're always either projecting today's money into the future or discounting future money to its value today. This is how we compare investments, price stocks, and decide what's truly worth our money. Without understanding this, finance remains a mystery. But with it, you unlock the logic behind every financial decision. It all starts with that one simple, undeniable truth. Imagine your friend offers you 100 rupees now or 110 rupees in a year. Which do you choose? The bigger number is tempting, but the time value of money says pause and think. If you take 100 rupees today and invest it at 5% interest, you'll have 105 rupees in a year. Your friend's offer of 110 rupees is better than the bank's 5%. It's a 10% return for waiting, but if you could invest at 12% elsewhere, you'd have 112 rupees, making your friend's offer less attractive. The real question: can you earn more by investing now, or is waiting for the bigger payout smarter? This is the essence of financial analysis, comparing what you're offered for waiting against what you could earn yourself. Every investment decision boils down to this trade-off. The time value of money helps you see the hidden cost of waiting. It's not just about more money later, it's about what you give up today. That's why every rupee has a clock ticking on its value. Understanding this lets you make smarter choices every day. That's the power behind every financial decision. This brings us to 2 key calculations: future value and present value. Future value asks, if I invest today, what will it be worth later? It's about compounding, earning interest on your interest. For example, 100 rupees at 8% grows to 108 rupees in a year, and even more the next year as interest compounds. Present value flips the question: what's a future sum worth today? This is discounting. If you're promised 110 rupees in a year and want a 10% return, its present value is 100 rupees. You can calculate this using a simple formula that adjusts for time and interest rate. If someone offers you less than the present value, it's a bad deal. These calculations are the backbone of smart investing and valuation. They let you compare money across time, objectively. Now, scale up from coffee to companies. A business's value isn't its past or its assets. It's the sum of all the cash it will generate in the future. Investors buy a claim on those future earnings. To value a company, you forecast its future cash flows. The further in the future, the less each rupee is worth now. Add up all those future cash flows and you get the company's intrinsic value. This is called discounted cash flow, DCF, analysis, the gold standard for serious investors. It grounds valuation in future earning power, not hype. The most important part of figuring out what future money is worth today is the discount rate. Basically, the return you want for waiting to get paid. This rate takes into account both how long you have to wait and how risky it is. A safe investment, like a government bond, is the starting point for waiting. But most investments aren't risk-free, so you need to add something extra for the risk. The riskier the company, the higher the rate you'll want, and the less its future money is worth to you today. This rate depends on what you expect and what the market thinks about risk. Experts look at company risks, what's happening in the industry, and the economy to decide on a fair rate. It's a mix of careful thinking and experience, and it can make a big difference in how much a company is worth. Get this right, and you'll have a clear picture of a company's real value. From coffee to corporations, the lesson is clear. When you get money matters as much as how much you get. The time value of money is your compass for every financial decision: saving, investing, or valuing a business. Start early, and compounding works in your favor. High-growth companies are sensitive to interest rates because their profits are far in the future. DCF is the professional's tool for cutting through market noise and focusing on fundamentals. Every decision is a trade-off between now and later. Mastering this concept puts you in control of your financial future. Remember, a rupee today is worth more than a rupee tomorrow, and knowing how much more is the key to smart decisions. If you'd like to use the same approach to value real companies, check out stockvaluation-io. We've built the tools so you can focus on the insights.